So in today's video, we are going to answer the question, can you have a minimum premium and still pay a lot of money into a whole life insurance policy for a long time? Meaning if you say, I want to be able to pay as much money as long as possible, but I want to have as much cash value as I can up front and also long term, is that possible? Meaning, can I shrink that base premium as low as the insurance company will allow? The answer is yes. So what I'm going to start with is an objection we hear around this a lot, particularly in the infinite banking space. So the objection we hear is, don't go with a low base premium because you want to equip your policy or set it up in a way where you can pay as much money for as long as possible. And the argument to support this is that you have to have a higher base premium. Is that true? It's not when we look at different companies and products, but we're going to go through this in detail. So it begins with designing a life insurance policy. So for example, if you said, I want to fund a life insurance policy with $10,000 per year, you, the policyholder, can decide where that $10,000 goes. There's two areas, your base premium or what is called your PUA rider, which stands for paid up additions. So to go through this very quickly, with a whole life insurance policy, if you're going to fund $10K per year, money again can go toward the base premium or toward the PUA. Dollars that go toward the base premium, let's say it's your full $10,000. What's going to happen with your life insurance policy? With most products, you will see zero show up in cash value in the first year, and sometimes the first and second year. So let's say first year, zero, and then as you continue to pay that premium, eventually you start to see cash value build up. Now the reason why I have zero initially is because the insurance company is going to overcharge me for the cost of insurance or the death benefit up front. So that $10,000 premium will give me zero in cash value in the first year, but it might give me a $1 million death benefit. Does that make sense? Cool. Now, if you said, well, I'm not into the idea of having nothing in cash value to start, which I would say that's good. I would not do that either. Here's what you can do, which imitates what a lot of corporations do with these products. You can reduce the premium. I would ask, how low can I go with the premium with this specific insurance company? All companies are different. If you look at the four major mutuals, you can usually push that as low as 10%, which would give you a $1,000 per year minimum premium. The $1,000, just like the $10,000, does not show up in cash value in the first year. Because you only have 10% going to the premium, you may only see a $100,000 death benefit to start. Now we'll also attach what is called a term insurance rider, and this is just a cost-effective way to raise the death benefit, which mainly raises the MEC limit, which prevents a taxable event. We've got other videos that go into detail on that. But point is, we want to put the least amount of our $10,000 toward the premium, and then put the rest down into our PUA rider, $9,000, which I like to call a cash dump-in. The reason why I like to call it that is because guess what happens to that $9,000 you pay into the policy? Shows up in cash value. Now you feel like this instead of this. That's better, right? Now, typically you'll see somewhere between 90 and 95% of that PUA payment show up in cash value in the first year. It's not 100%, and we always like to add that piece. Now, if I threw $9,000 into the PUA payment, that might get me somewhere between $20,000 and $30,000 in additional death benefit. So it does buy some life insurance, but why people put money here is for this. So, seeing this, where would you want to put money if you're interested in a whole life insurance policy for the cash value? PUA rider. Shrink the premium, maximize the PUA rider, you'll have more money. If you really want to see how that works, request to look at the guaranteed cash values of a life insurance illustration. The non-guarantees, you can spin them where a high base premium might show more 30 or 40 years down the road. Nope, ask for the guarantees. That'll let you see exactly how things work. Okay, so back to this. The argument here, as far as why someone would go with a higher base premium, is if I'm funding $10,000 per year, we might hear, hey, you should put your premium at $4,000 instead of $1,000. So if I put my premium at $4,000 and my total payment is $10,000, that means I'm putting $6,000 into the PUA rider. So instead of $9,000, like what we just saw, I'm only putting $6,000 here, which means I'm going to have less in cash value. Now with this argument, we often see a 10-year term insurance rider attached, which means after 10 years, the term rider is dropped. And if I keep paying that $6,000 per year PUA payment after the term is dropped, the policy is eventually going to MEC in the majority of cases. So to wrap this argument up that we hear, the solution is, well, you can pay $10K per year for 10 years. Then after the 10th year, we're going to drop the term rider, and then you can just keep paying the base premium. And if you just keep paying the base premium, usually you're not going to run into a MEC, which is true. So that higher base premium then supports the argument that you can pay more money into a whole life insurance policy for a longer period of time because you have a higher base premium. You're just paying more toward the premium, and after 10 years, that is coming back to cash value. That's the argument. I say this to the argument. No, there is a much, much more attractive way of doing things. You typically just have to ask to see different options and also ask to see different companies. So you can have a minimum premium and keep adding money to PUAs and have more cash value up front and have more cash value long term and have more flexibility, meaning you're only committed to the base premium. Going back to this, why a lot of people like this type of setup is I can set it up where I'm only billed for this, meaning you pay this one time per year or over 12 months, and then this can be added at your leisure, depending on the company that is. But I'm not on the hook for that full $10,000 every year. It's just the minimum premium. So let's demonstrate this. What we'll start with is an illustration with a major mutual company. We're going to pay into it first for 5 years, and then we'll gradually make it longer. So here's our 100K per year, 100,000 per year. Look at your first year cash value, $92,000. By the 4th year, how much did you pay in total? $400,000. 100 per year for 4 years. You have $399. And by the 5th year, you've got $510. So you've got more in cash value than what you paid in. Here's your premium. Here's your PUA. And then this guy is a combination of term and PUA. That's a 1-year term insurance rider. You can also refer to it as a blended PUA rider, which is what we have used forever for corporations that are getting whole life insurance policies and maximizing the cash value. The term riders do not get too expensive with those riders unless you just neglect the policy or you're not super familiar with them. Okay, so that's funding for 5 years and then stopping. Now let's look at the same policy. Take note of year 5. What are you at? $510,000. Here's the same policy, but we're going to keep on adding money. So here, 100K per year. By the 5th year, what do you have? $510,000. Difference here, we keep on adding money. Look at this. So we keep going. For how long? 25 years in this particular case. Let's look at one more, and then we're going to look at these side by side on Excel. First things first, here's a page of the illustration buried deep within. Important tax information. The policy is not a mech. So having a low base premium and adding a lot of PUAs for a long time will not always result in a mech. Same policy, by the 5th year, there's the same $510,000. The difference here is by the 30th year, we're still feeding it. Let's go to the next page. What do you notice here? We paid until age 85. Never meched, had a lot of cash value up front, have a ton of cash value long term, and I also have flexibility because I can always shrink my payment down to the minimum premium, in this case of about $10K per year, and then dump more money into the policy on years where I want to scale it back up. Makes sense? Making it very flexible. So let's look at these guys side by side. Here we go. So here's the 5-year illustration. Then we've got the 25-year illustration, and then the as long as possible, demonstrating what we just saw in the illustration, where the premium is 10K. The premium plus the term rider is right around 10K. And there you go. With the option to pay in less than 100 on any year that we want, to go longer than 25 years, shorter, you can pivot as you go. So with all of this said, why would I go with a higher base premium? There's typically 2 reasons that we see. The first is we are shown a company that has PUA restrictions. So for example, if I work for a life insurance company that only allows me to illustrate a maximum of 3 times my base premium, that might be one reason I, as an agent, do not show you an option with a 10% minimum premium. The second reason why is down here, when we look at how commissions work with whole life insurance products. So commissions are paid on base premium dollars and PUA dollars. However, they are significantly higher on base premium dollars. When we look at the base premium, if it is one of the 4 major mutual companies, that commission is going to range somewhere between 85 and 95% with the product that is going to pay the highest upfront. Some of them will pay a maximum of 18% in the first year, which is actually the example we just looked at, that high early cash value product. And then if we look at smaller companies that typically do not solicit business in the state of New York, those commissions can be as high as 130%, sometimes higher actually. But that is a reason why, just being in the industry for years and seeing what goes on. So with all of that said, I do hope that this video was helpful. I would love to hear any thoughts you have. Please leave any thoughts, questions, or comments below in the comment section. And as always, I hope this helps.